It's what makes people buy homes they can't quite afford, invest in futures they can't quite see, and sleep at night with a mortgage hanging over their head. But when confidence disappears, the whole machine stalls. Today, the numbers are in. Consumer sentiment is below 92. But here's the secret. When fear grips the crowd, that's when opportunity quietly moves in. With us is Westpac Chief Economist Kelly Eckhold, friend of the show, straight talker, and one of the few people who can read the pulse beneath the panic.
Financial freedom faster. Financial freedom faster.
Before we dive in, take 30 seconds to see what thousands of Kiwis already know. MortgageHQ's snapshot isn't just data, it's strategy. It's how investors stop guessing and start buying. Links in the description, you'll thank yourself later. Kelly, consumer confidence has dropped well below the long-term average. What does this shift signal for New Zealand house prices heading late into 2025?
Well, certainly right now in the middle of the year, the consumer and households are having a bit of a wobble. There's been quite a bit of bad news or scary news sort of been going on now probably for about 2 or 3 months, particularly around what's been going on out there in the world. There's obviously some wars that have been underway, quite a lot of trouble in the Middle East. And I think that has consumed people's attention, combined with the fact that at this time of year, often life just seems like it is a bit tougher. You know, we're basically going through the winter. We have a lot of holidays, for example. So a lot of businesses complain a lot that this is not an easy time of the year to make money because it feels like everybody's off on holiday. And we've seen that reflected, I think, in things like consumer confidence metrics that have been bouncing around. They've had some rough and smooth. They're still higher than they were probably a year ago before the interest rates started to get cut. But we have seen that kind of like bounce up and bounce down in recent months.
As we look at the buyer behaviour, are we starting to see cracks in the sales momentum, or is the worst even still to come? Is it a seasonal thing, or?
So in the house price data that we received for last month, that was a bit disappointing because prices went backwards by about 0.3% overall. And that was obviously a bit different than what I would have expected, really, where we'd sort of seen this string of increasing house prices for perhaps 6 or 7 months before that. Not large house price increases, but certainly a fairly stable and steady progress. I think that what we have seen there is increasingly a bit of a divide between the trends in activity in the market and prices, where prices are now going, I think realistically we can say that they've been going sideways for the last couple of months. I wouldn't really suggest that prices are falling right now in a general sense. But activity in the market, if we look at the number of sales, that's basically sitting around average levels. And that's a bit unusual because usually we see trends in activity mirroring changes in prices. So with activity having recovered to sort of pretty average levels now, you know, we'd normally expect to see probably stronger house price gains in that, but that's not what's happening. I think the thing there that's going on is that on the demand side, there has been the news which has been more variable, which has perhaps undermined confidence a little bit at the margin. I think it's also fair to say on the demand side that the labour market has also been a little bit weaker than people would like. Probably people are still really looking a bit forward to the closer to the end of the year or next year before they think employment prospects pick up. And on the supply side of the market, it remains the case that there's still quite a lot of properties on the market available for sale. So from a buyer's perspective, they feel like they've got plenty of choice and they certainly don't have any need to pay up at the moment. And I suspect that's probably really why the prices aren't really going anywhere, even though there's property turning over.
With the cost of living still rising, wage growth slowing down, are we hitting this hard affordability ceiling that will suppress the price growth? Or, I mean, even if rates fall, can property prices go up?
I think there is a bit of an issue there where people are still a bit disgruntled about the cost of living. And from an investor's perspective, I think one story I see a lot of is the ongoing costs of rates Lesser insurance, actually. Insurance costs actually probably aren't rising like they have been in the last couple of years, but probably the increase in local authority rates remains the biggest single factor that upsets investors right now in the market. And for households more generally, you would have seen the rise in the CPI. That's printed up at 2.7% annual, which is sort of right up towards the top end of the Reserve Bank's 1% to 3% range. Lots of commentary there about the price of some staples like butter rising quite significantly as well. That all just takes money out of people's pockets that they can't to deploy to other things. Interest rates are falling, which is giving them some money back, but it's just probably interrupted the flow of positive cash flow that we're expecting to kind of see gradually take over the trend in the economy if we look forward in the next 12 months.
Well, hopefully people are not replacing expensive butter with shitty margarine. Which regions are bucking this national trend? Where is the confidence still strong enough to support investor activity and the price stability?
The regional picture remains as it has been for a while. So we continue to see strength in the South Island, Canterbury, Otago, Southland. We continue to also see strength in the Waikato as well, and you could understand that given that the dairy sector and the agricultural sector remains relatively strong point of the economy at the moment. Where the weakness is in the major urban areas, particularly in Wellington, where frankly prices are falling there at a reasonable clip. And Auckland has not really kicked on, and we saw a bit of a fall in house prices in the last month, even though activity has continued to pick up.
Kelly, Wellington stands out as deeply pessimistic. Is this the canary in the coal mine for politically exposed urban markets?
It certainly is a politically exposed market. It has been for the last couple of years, and that's really continuing now. In the budget, the minister didn't really promise any more money for Wellington, really. The money that was thrown around was in the investment boost policy, which is basically more likely to be spent out there in the regions, or maybe in the commercial property market as opposed to kind of like Wellington. So, with departments there continuing to need to operate on flat budgets, it means that they're continuing to, they're certainly not giving pay rises. Perhaps there's a bit of restructuring going on in some of these government departments as well. If you've got new responsibilities but you haven't got more money, then you basically have to cut a bit of your existing cost base to be able to continue to deliver. And I think that is basically going to be the story of Wellington for the rest of this year.
Well, household finances are under pressure. Mortgage rates are falling. Do you expect a delayed surge in buyer confidence as borrowers refix on the lower rates?
Well, what I see there is that refixing process is continuing at pace. So in the background there are lots of households every week that are getting lower interest rates and better payment terms than they had sort of like 3 months ago or 6 months ago. That's going to continue through to the end of the year. So that should continue to be a supportive sort of, I would consider it a structural factor, because I don't really see mortgage rates increasing at any stage in the next 6 months, really. I think, though, the sort of more negative temporary factors have been the things around the kind of global economy, which I think are actually starting to settle down a bit. There's still plenty of noise out there, but what we have seen is that the US authorities have completed some trade negotiations with a few key trading partners. There was a big announcement just recently on Indonesia, Philippines, and also Japan. So these are the sort of things that are useful, because it's not that the tariffs are going away for the world, but it's becoming clearer what they're going to have to pay, and therefore people can start adjusting.
42% of households reporting financial deterioration. How could this reshape rental demand, yield expectations, and the investor behaviour?
Well, I think one of the things that investors are going to have to think about here is where they get their return from. in the last 20 or 30 years, there's been a high expectation of capital gains, strong capital gains sitting there in the minds of investors about how they're actually going to get their return. Increasingly, though, we're probably less likely to see those capital gains to be quite as strong. So hence the kind of like the rental yield, I think, will be increasingly important. The level of the mortgage rate that you're paying will be increasingly important as well. And all of the things that make your property more desirable compared to the general stock of rental property as well will be quite important for investors. So people are probably going to have to focus a little bit more on the details now, whereas maybe 20 years ago, 10 years ago, or certainly in 2021, you could have just closed your eyes and bought anything and the price would have gone up.
Yeah, in a delicate way, I did try to tell people years ago that some of the dumb luck of just buying property is the reason they have wealth. Most people like to attribute that success to their own intelligence.
There's quite a lot of Bitcoin investors actually there thinking about exactly the same thing, right? You just close your eyes and buy, and if you wait long enough, it will go up.
Kelly Eckhold, Chief Economist, Westpac, thanks for your time. But before we go, if you want freedom, not theory, not the mindset, if you want the moves, tactics, and a playbook, then you want the 3 property formula book. Now, I've written the strategy real investors use while the rest panic. Built from the trenches, no fluff, no seminars, just results. You want to own the blueprint? Grab the book and give yourself the unfair advantage 95% will never get.